Hello everybody and welcome to the ISG 2020 Tech Exchange for Banking, Financial Services and Insurance. My name's Owen Wheatley and I'm the lead partner for financial services at ISG. Before we get into the three specific themes of today's event, I'm going to take some time to share my perspective on the BFSI industry more broadly and how it's coping with unprecedented levels of disruption. Specifically, we're going to take a look at the impacts of COVID-19 and the storm it has created, examine the priorities and imperatives for firms across the BFSI spectrum, and conclude with a few thoughts about how ISG sees the industry moving forward. Let's begin by reflecting on the last 6 months, which by any measure has been volatile, chaotic, and in many cases has represented an existential threat to business survival. I like this quote from Henry Mintzberg because it can also be applied to businesses. Those financial institutions who are adaptable and agile can pivot much quicker to the new business models required to survive and thrive in the emerging world. Those who are overly encumbered by legacy technology, unwieldy processes, and a lack of operational flexibility are struggling to stay alive. Now, I have an economics degree, and economists, like many people in financial services, are fond of identifying trends and making predictions for the world around us. Even in what might be called normal times, those trends and predictions often miss the mark. But in 2020, many of us have been made to look somewhat foolish by the storm caused by COVID-19. By way of example, here are 3 predictions made at the start of the year. Saxo Bank from Denmark is known for making bold predictions each year, but this one was way off, as we've seen central banks reduce rates to historical lows. Up until COVID-19 struck, Monzo was considered one of the darlings of the new startup banks. But their recent admission that there is significant doubt about their ability to continue as a going concern shows they're not as resilient and adaptable as everyone thought. And just to prove that anyone can make a terrible prediction, back in January of this year, on the ISG Index call, I predicted that 2020 would be a relatively stable year for banks. Say no more. The reality is that 2020 has been a tough year for most financial institutions in terms of revenue, profit, and stock price. The collapse hit all parts of the sector. By way of example, Wells Fargo, CNA, and Charles Schwab stock fell by at least 30% during the 6 months from February to early August, and they were not alone. Despite these stocks making partial recoveries since, there's still a lot of lost ground to be made up. The broader macroeconomic picture was equally bleak, as US GDP fell 33% in Q2 on an annualized basis. US unemployment went from 3.5% in February to almost 15% in April, and US federal debt increased by $4.5 trillion, that's 20%, in July 2020 compared with a year earlier. So let's consider some of the major impacts of COVID-19 on banking, financial services, and insurance firms. Of course, each individual business has been affected differently according to their specific situation. For example, their degree of exposure to interest rates for income. But there were some common themes. For example, we saw almost all firms scrambling to arrange and fund remote working for employees at very short notice. This requirement came with significant challenges, including the logistics of equipping workers with the right technology, deploying appropriate collaboration tools, and ensuring security of data. Those with offshore delivery centers struggled to ensure business continuity as these changes became necessary. And those leveraging third parties anxiously waited to see if their traditional ecosystem was up to the task. For their part, service providers had to rapidly adapt their standard operating models, train resources to work effectively from remote locations, and clearly demonstrate continuity of service. In many cases, they were forced to seek forgiveness from financial institutions for known breaches of KPIs and service levels, and regulators around the world watched with interest to ensure compliance standards were maintained. More investment and resources were required to distribute the enormous federal stimulus in the US and around the world. In some countries, this lending is not all government guaranteed, so provisions for future losses have increased dramatically. One bank's provisions for those losses jumped by 450% year over year in Q2. Banks exposed to high-risk sectors such as hospitality and travel have even more potential headaches, with payment holidays granted on loans and future loan defaults expected. Insurance firms have seen something of a mixed picture when it comes to claims, with transport and activity-related claims dropping sharply due to the lockdowns, but losses and medical claims rising significantly. As with banks, exposure to badly affected commercial sectors has led to unpaid business premiums, dampening income levels amongst those firms not so well diversified. The simple logistics of millions of people trying to contact their insurer has also highlighted the need for increased channel capacity and better customer communications. Other impacts have been caused by the changing behavior of employees and customers. With restrictions on travel and everyone operating their daily lives from home, there's been a rapid increase in customer engagement via digital channels, placing greater emphasis on mobile application functionality, online experience, and contact center effectiveness. From an employee perspective, remote working has forced executives to focus on the future as it relates to corporate real estate. What should the role of branches be in the new world, and how many are needed? And in terms of headquarters premises, when the CEO of Barclays says the days of thousands of people working together in a London office are over, we know it's a serious cultural shift. But disruption in BFSI is not only because of COVID-19. We shouldn't forget that this was an industry already reeling from questions about how to leverage new technology and waves of new entrants. Think of Chime, Robinhood and Stash in the US, Starling in the UK, or new insurers like Lemonade and Hippo. Often these startups or scale-ups are rooted in a commitment to customer experience and the use of smart technologies, often combined with a popular blend of ethics and corporate social responsibility. That's why they're so attractive to investors and receive such high valuations. By way of example, consider the comparison between Zions Bank and Revolut, the UK-based startup bank. Zions is a revered 150-year-old institution with a great reputation, 10,000 employees, $3 billion in annual revenues, and a healthy profit margin. Revolut is 5 years old, with annual revenues at just $200 million, and they've recently announced a tripling of annual losses to $140 million. Given these statistics, it's amazing to think that Revolut has the higher market valuation based on their latest funding round. To some extent, this shows the premium investors have placed on customer experience and technology. So what does all this mean for our industry today? I'm going to talk about the priorities and imperatives for firms within 4 categories: retail banks, asset managers, investment banks, and insurers. Let's start with retail banks. I just mentioned the premium placed on customer experience by investors, and that's for a good reason. In a recent survey, more than 50% of customers already use or intend to use a digital-only bank, even if it's in addition to their incumbent provider. The number one reason for doing so is customer experience. Why would someone put up with the hassle of physically taking 2 forms of identification into a branch and spending up to 90 minutes providing further information to set up a new current account with a large established bank, when it takes 10 minutes and an uploaded driver's license to do the same thing on a mobile phone with a new firm like Revolut? For these large established banks, the main risk is disintermediation of primary customer contact and preference data, which is why upgrading customer experience remains such a huge driver for them. As a primary interface between customer and bank, this is one of the reasons why contact center has become such a focus for investment and redesign, and we'll be presenting much more on this topic later today. Attracting top talent has always been tough for financial institutions because of the sheer number of firms competing for the brightest and best. But now they're also battling the big tech companies as well as the new startups and scale-ups I mentioned earlier, who are so attractive to millennials and Generation Z. Areas like data science, innovation, and product development are seen as differentiators, requiring the best skills from the market. So talent acquisition struggles make it even harder to grow the top line, which has been an area of concern since the financial crash of 2008-9. For asset managers, with their exposure to interest rates and market volatility, they've been hit particularly hard by COVID-19. Already under intense margin pressure, we see these firms looking for new channels, new products, and ways to unlock the value of customer data. We also see them facing increasingly complex and uncoordinated global regulations, whilst wrestling with the question of whether or how to leverage robo-advisory models. They too are now competing with new customer-centric entrants with slick user experience and lower fees, such as Robinhood, recently valued at more than $11 billion, with an average customer age of just 31. With income typically less exposed to interest rates, you may think that investment banks are better placed to ride out the storm. But they have their own long list of challenges to address, including how to enable remote trading with all its associated technology and security implications, and how to build new differentiated client-centric, not product-centric business models based on market insight and incorporating performance-related fees and incentives. This is one of the reasons we see some of the biggest firms partnering with new fintech platforms, such as JP Morgan leveraging WeMatch for securities trading and Goldman Sachs leveraging Nutmeg for digital wealth management. These firms too are battling to remain compliant in multiple jurisdictions as the post-financial crash era of regulatory coordination dissipates, and they must quickly draw up plans to monetize or at least optimize their large central business district footprints. For insurers, once again, customer experience is king, and this explains why we see such efforts to reduce journey friction and enable omni-channel access. The engine room of insurers, claims and underwriting, is undergoing significant transformation, both in terms of automation, for example, to improve risk assessments and increase claims predictability, and leveraging data for customer insights. Insurance firms are increasingly feeling pressure to refine their offerings to truly meet customer needs. As a KPMG study put it, when referring to customers thinking about their insurance policies, do I have the cover I need, and do I need the cover I have? New models such as Cover's Insure As You Drive offering, which allows a customer to pay by the hour for driving vehicles, which may not even be their own, requires new technology and the same kind of adaptability I mentioned right at the beginning. Even these innovative new models, however, must navigate the choppy waters of data ownership and privacy. Finally, in this session, I'm going to pretend that making predictions is still a good idea and give you my thoughts on how the financial services industry will evolve over the next 12 months. Of course, this comes with a flashing health warning in such uncertain times, but I'm confident that these themes will survive whatever the world throws at us. Firstly, I predict the continued shakeout of startups and scale-ups in the next 12 months. We heard the salutary tale of Monzo earlier, and despite the attraction of new logos and better customer experience, many consumers are creatures of habit. We're simply not switching full services to these new banks quickly enough. In fact, the average balance in a digital bank account is less than $350 today. We also saw in the Revolut example the other major problem for startups and scale-ups. Most of them simply don't make a profit. Investors understand this and in normal times are prepared to wait for the expected returns. But in a wildly volatile market, patience wears thin and funding is much harder to secure. This is prompting many new entrants to articulate business strategies to show an early profit or at least a plan to get there, such as Dutch startup Bunk's subscription-based fee model. Second, I expect to see a resurgence of the merger and acquisition spike we saw in 2018 and 2019, especially amongst US firms. In uncertain, chaotic times, scale is your friend, and so is synergistic cost reduction. So I predict more examples like Truist, Franklin Templeton Legg Mason, and Charles Schwab TD Ameritrade. Third, as I alluded to earlier, I believe we'll see further disintermediation in the industry caused by firms acting as financial services broker or concierge, offering customers a best-of-breed experience, with established institutions potentially being reduced to competing on price in the background, much as we have seen in the utilities sector. When I interviewed the deputy chief executive of a new bank in London, he told me that they wanted to be seen as a financial lifestyle advisor, not a bank, because he believed that's what today's generation of customers wants. This reshaping of the industry will be exacerbated by the continued encroachment into financial services of the big tech companies like Apple and Google. Fourth, I predict further divergence in global regulation as the more centralized US bodies concentrate on new challenges like digital currencies, and Europe provides slower, more considered regulation to a deeper financial shock and also wrestles with a lack of coordinated alignment across the continent. Fifth, I see an acceleration in the adoption of platforms to drive end-to-end process effectiveness and increase speed to market. This will go hand in hand with a push towards newly evolving ecosystems where financial institutions will partner with or acquire fintechs and insurtechs to enhance their customer propositions whilst embracing third-party providers of services in the middle and back offices. Focusing on the things considered differentiators and engaging experts in all other areas will become the prevalent business model. The final three items on this list are highlighted because they represent the main themes of today's event. The focus on the customer-employee axis, both in terms of productivity and driving higher revenues, is perhaps most acutely felt in the contact center of the future, and we'll hear much more about that from Sandra Williams later in this event. Finding the right use cases for the multitude of automation technologies such as machine learning and AI is becoming a pressing challenge for all financial institutions. How to drive customer intimacy and engagement, combat financial crime, and make better use of data are just 3 of the areas Jay Waldau will be covering in his session. Finally, even before COVID-19, every financial institution was undergoing some form of transformation, whether that was automation, cloud migration, enterprise agility, or something else. I now see significant interest in organizations trying to understand where they are on those journeys, both against internal expectations and versus industry peers, and being able to measure the value of that transformation. My colleague Prashant Kelkar will delve into this topic later in the event. I hope you found this snapshot of the banking, financial services, and insurance industry interesting. Before we move on with the rest of our content-filled day, I did want to provide you with a little information about today's program. Some of you know us well, but for those of you who are here for their first ISG conference, we're a leading global technology research and advisory firm. We specialize in digital transformation services, including providing deep subject matter expertise, market data, and financial frameworks. This is one of about 25 events that we do globally and virtually. We'd like to thank our sponsors for their support. We could not have done this event without them. We have an exciting agenda planned for you today, which you can view on the left side of your screen. Our day is broken up into 3 themes: contact center of the future, a disrupted industry, the impact of automation, transformation, and measuring value. Our agenda will have general sessions, as well as 2 streams, with one focused on banking and financial services, the other focused on insurance. Please note the session times in the agenda for the 2 streams and our general sessions. Brella is the platform we're using for this virtual conference, and it has many features you should take advantage of. Chat with attendees, take polls, download white papers, and more. For information about accessing its features, check out the More section on the left-hand side of your screen. After the conference, you'll be receiving a link to a feedback survey. It would be appreciated if you could complete the survey and let us know your thoughts on how we did today. Thanks again for joining us, and be sure to use the hashtag ISG events in your social media posts throughout the day. Also, to get the networking started, we'd love to know where everyone is located, so just let us know your location in the chat feed to the right. To kick off with a real bang, it's my pleasure to introduce you to our first speaker of the day. James Bell is the head of AI and machine learning at Dow Jones. James is recognized as one of the top 250 IT leaders in the UK, an international public speaker, and a published writer on such topics as alternative data, risk and compliance, and AI ethics. For 20 years, he's worked in financial services, providing leadership in AI, risk and compliance, payments technology, business consultancy, and IT management. He'll be presenting on ethics in AI, reputation, privacy, and liability. If you have any questions for James, please enter them in the session Q&A on the right-hand side.